We are witnessing something unprecedented in American political and financial history. A sitting president who has purchased up to $2 million in bonds from Netflix and Warner Bros. Discovery just weeks after these companies announced their merger, while simultaneously asserting he will have a say in whether that very merger receives regulatory approval, and then amplifying social media content calling for the deal to be blocked on ideological grounds. This is not a minor ethical gray area or a technical conflict of interest that can be rationalized away through legal gymnastics. This is a direct, unambiguous situation where the President of the United States has immediate financial stakes in companies whose fate he claims authority to determine, and where his public statements and social media activities suggest he may be using that authority to advance both his political preferences and potentially his financial interests. The fact that this situation has unfolded with relatively muted public outcry and with White House officials offering boilerplate responses about blind trusts and independent management speaks volumes about how normalized conflicts of interest have become at the highest levels of American government, and how unprepared our institutional safeguards are for dealing with a president who operates simultaneously as head of state, media personality, and active investor with a portfolio valued in the hundreds of millions of dollars. The Netflix-Warner Bros. Merger saga has evolved from a straightforward business transaction into a perfect case study of how presidential power can be leveraged to influence market outcomes, how political connections and ideological alignments can substitute for competitive business fundamentals in determining which deals receive approval, and how the traditional separation between government authority and private financial interests has eroded to the point where it barely functions as a constraint on executive behavior. Let's break down the multiple layers of this situation systematically, because each element reveals something important about the current state of American governance, corporate power, and the media landscape. The first layer is the direct financial conflict. Trump's latest disclosure forms show he purchased approximately $100 million in municipal and corporate bonds between mid-November and late December, including positions in Netflix and Warner Bros. Discovery bonds. These aren't insignificant positions. We're talking about up to $2 million in exposure to the very companies whose merger he claims he'll influence. The White House defense is predictable and inadequate. An anonymous official stated that Trump's portfolio is independently managed by third-party financial institutions, and that neither Trump nor his family has any ability to direct, influence, or provide input regarding investments. This is the standard blind trust language that has been deployed by politicians for decades to create the appearance of separation between personal finances and official duties. But there are multiple problems with applying this framework to Trump's situation. First, even if we accept at face value that Trump doesn't personally direct these specific bond purchases, and given his history of involvement in his business empire and his public commentary on companies and markets, that acceptance requires considerable credulity. The mere fact that his portfolio contains these positions creates an appearance of impropriety that undermines public confidence in the integrity of the regulatory process. When the president owns bonds from companies seeking merger approval, and when bond values are directly affected by whether that merger succeeds or fails, there is an inherent incentive structure that exists regardless of whether the president consciously acts on it. Second, the timing is suspicious. These bonds were purchased weeks after the merger announcement, meaning Trump's portfolio managers were buying into a situation where regulatory approval was already a known issue, where Trump had already made public statements suggesting skepticism about the deal, and where the outcome would directly impact bond valuations. Third, and most fundamentally, the entire concept of a truly blind trust becomes meaningless when the president is simultaneously making public statements about the companies in question and asserting his authority over the regulatory process that will determine their fate. You cannot credibly claim your investments are managed independently and without your input when you are actively and publicly involving yourself in the business outcomes of those investments. The second layer involves Trump's direct assertions of presidential authority over the merger decision. In December, Trump explicitly stated he will have a say in whether Netflix can proceed with its proposed $83 billion acquisition of Warner Bros. Discovery's streaming and studio assets. This wasn't a vague comment about regulatory processes or a general statement about antitrust policy. It was a direct personal assertion of control over a specific transaction. This raises fundamental questions about the proper role of presidential involvement in merger reviews, which are supposed to be conducted by independent agencies like the Department of Justice and the Federal Trade Commission based on legal standards and economic analysis, not on presidential preferences or political considerations. While presidents certainly have the authority to nominate the leadership of these agencies and to set broad policy priorities, direct presidential intervention in specific merger decisions represents a significant departure from the normal process and creates obvious risks of politicization, favoritism, and corruption. When Trump says he will have a say in the Netflix-Warner Bros. Deal, he is essentially announcing that the regulatory review will not be conducted purely on legal and economic merits, but will incorporate his personal judgment and, given his financial stake in the companies involved, his political relationships with competing bidders, and his expressed ideological views about the content these companies produce, there is no way to separate his personal interests from any decision he influences. The third layer is the competing bid from Paramount Skydance and the political connections that surround it. Paramount has submitted a $118 hostile bid for Warner Bros. Discovery, backed initially by financing that included Affinity Partners, the private equity firm run by Jared Kushner, Trump's son-in-law. The involvement of Kushner's firm created an immediate appearance that the competing bid had inside track access to favorable treatment from the Trump administration, an appearance that was reinforced when a Trump administration official suggested ahead of the bidding process that Warner Bros. Should think very seriously about which suitor has been successful getting a deal done, specifically naming the Ellisons in reference to Larry Ellison, the billionaire backer of Paramount Skydance and a close Trump ally. This wasn't subtle. It was a barely disguised signal that Paramount's bid would receive more favorable regulatory treatment than Netflix's offer. The fact that Kushner's firm has now withdrawn from backing Paramount's bid, reportedly because the dynamics of the investment have changed significantly, adds another layer of intrigue. Did Kushner exit because the expected regulatory advantage didn't materialize, because the public attention to the conflict of interest became too intense, or because Trump's direct purchase of Netflix and Warner Bros. Bonds signaled a shift in where his interests lay? Regardless of the specific reason, the entire sequence demonstrates how merger outcomes in the current environment depend as much on political connections and presidential favor as on business fundamentals or competitive bid prices. The fourth layer involves the ideological dimension that Trump has introduced through his social media activity. Trump recently reposted on Truth Social an opinion column titled, "Stop the Netflix Cultural Takeover" by attorney John Pierce, who has represented Trump supporters involved in the January 6 Capitol attack. Pierce's argument against the Netflix-Warner Bros. Merger focuses not on traditional antitrust concerns about market concentration or consumer harm, but on cultural and ideological grounds. He argues that the combined entity would become an unprecedented cultural gatekeeper with the power to spread progressive narratives and woke content to a dominant audience, and he frames blocking the deal as necessary to preserve free expression and America's cultural pluralism. By amplifying this argument, Trump is signaling that his assessment of the merger will be based at least partially on the political and cultural orientation of the content Netflix produces, rather than solely on competitive or economic factors. This represents a dangerous expansion of the grounds on which government can intervene in private business transactions. If mergers can be blocked because officials disapprove of the ideological content companies produce, we have effectively abandoned the principle that government should not use its regulatory power to favor or punish speech based on viewpoint. The irony is profound. Pierce frames his opposition to the Netflix deal in terms of preserving pluralism and preventing monopolistic control of culture, while simultaneously advocating for government to use its power to prevent a merger specifically because of disagreement with one company's content. Choice is this is not preserving pluralism. It's attempting to use state power to enforce ideological conformity. The fifth layer is the bipartisan opposition to media consolidation, but for very different reasons. Senator Elizabeth Warren and other Democratic lawmakers have also expressed opposition to the Netflix-Warner Bros. Merger, but their concerns are traditional antitrust arguments about market concentration, the elimination of competition, potential harm to consumers through higher prices and reduced choice, and the accumulation of too much power in a single entity that controls production, distribution, and platform access. Warren has explicitly warned that the Trump Justice Department's handling of this merger review could turn into an influence-peddling exercise rather than a legitimate application of antitrust law, and she has argued that both the Netflix bid and the Paramount bid should be blocked on competitive grounds regardless of any political considerations. This bipartisan opposition to the deal creates an interesting dynamic. Both Trump and progressive Democrats oppose the Netflix merger, but for fundamentally incompatible reasons. Trump because he views Netflix as ideologically unfavorable and because his political allies back the competing bid. Warren because she views any further media consolidation as harmful to competition and problematic for democracy. The fact that opposition comes from across the political spectrum doesn't mean the opposition is principled or consistent. It means different factions are using the same regulatory tools to pursue entirely different and sometimes contradictory objectives, which further politicizes what should be a technical, legal, and economic analysis. The broader implications of this situation extend well beyond the specific fate of the Netflix-Warner Bros. Merger. We are establishing precedents about what level of financial conflict of interest is acceptable for a sitting president, about what degree of direct presidential involvement in specific regulatory decisions is normal, about whether ideological and cultural considerations are legitimate grounds for blocking business transactions, and about whether political connections and presidential favor have become more important than business fundamentals in determining which deals receive approval. Each of these precedents weakens the institutional barriers that are supposed to prevent corruption, favoritism, and the abuse of government power for private benefit. When a president can own financial stakes in companies whose regulatory fate he directly influences, when he can amplify ideological arguments against deals while his political allies back competing bids, when administration officials can openly signal which bidders will receive favorable treatment. Based on political relationships rather than legal criteria, we have moved from a rules-based regulatory system to a patronage-based system, where outcomes depend on access, connections, and presidential whim. This is not a sustainable foundation for either democratic governance or functional markets. It creates massive uncertainty for businesses that cannot predict which deals will succeed based on legal analysis. It invites corruption as companies and investors seek political connections to influence outcomes. It undermines public confidence in the integrity of government processes, and it concentrates enormous power in the executive branch without adequate checks or accountability. For investors and market participants, the Netflix-Warner Bros. Situation provides a clear example of what political risk looks like in contemporary America. Traditional financial and competitive analysis are necessary but insufficient for predicting outcomes, because the decisive factors increasingly involve political relationships, ideological alignments, and presidential preferences that can shift unpredictably. The fact that bond markets and equity markets have not priced in more volatility and risk premium around these merger transactions suggests that investors are either in denial about how politicized these processes have become, or they believe they can predict and trade around political interventions. Effectively, both assumptions are probably wrong. Political risk of this type is fundamentally difficult to model and price because it depends on personal relationships, private communications, and decision-making processes that are opaque to outside observers. The withdrawal of Kushner's firm from the Paramount bid, Trump's bond purchases and the companies involved, his public statements asserting control over the decision, his amplification of ideological arguments against the deal, each of these developments was difficult to predict in advance, and each significantly altered the perceived probability of different outcomes. This is not an environment where traditional due diligence and financial modeling can give you confidence in your investment thesis, because the decisive variables are political rather than economic. For the media industry more broadly, the message is clear. Your ability to grow through acquisition, to achieve the scale necessary to compete in global markets, to vertically integrate production and distribution, all of these strategic imperatives are now subject to political approval processes that are arbitrary, inconsistent, and potentially corrupt. The winning strategy may not be to build the best products or make the most competitive bid, but rather to cultivate the right political relationships and align your content and public positioning with whatever ideology the current administration favors. This is a recipe for mediocrity, sycophancy, and the erosion of the very creative excellence and competitive dynamism that has made American media companies globally dominant. For citizens and consumers, the implications are perhaps most disturbing. The government is asserting the power to decide which media companies can merge and grow based partially on ideological assessment of their content, which means government is effectively exercising indirect control over what stories get told, what perspectives get amplified, and what cultural products get created and distributed. Whether this control is exercised to prevent woke content or to prevent right-wing content, the principle is equally dangerous. Government should not be in the business of using its regulatory authority to shape the ideological orientation of media and entertainment, because that path leads inevitably toward state influence over culture and speech that is incompatible with genuine pluralism and freedom of expression.